How is equity compensation taxed? If you're surfing the corporate wave, chances are you've been compensated in ways that extend beyond the traditional paycheck. Equity compensation, which can include stock options, restricted stock units, or performance shares, is a popular strategy companies use to attract and retain top talent. But how does the IRS view these offerings, and how exactly are they taxed? Let's dive into understanding the taxation of equity compensation so you can maximize your benefit while staying in good standing with Uncle Sam. Understanding stock options, incentive stock options, ISOs, and non-qualified stock options, NSOs. Equity compensation often comes in the form of stock options. It's vital to distinguish between incentive stock options and non-qualified stock options, since they have distinct tax implications. Number one, incentive stock option, or ISO. Generally, ISOs do not generate a tax liability when you receive or exercise them. Tax comes into play when you sell the shares. If you hold them for at least a year after exercising and 2 years after the grant date, the gains are treated as long-term capital gains, typically taxed at a lower rate. However, be cautious of the alternative minimum tax, which can apply. Number two, non-qualified stock option, or NSO. Unlike ISOs, NSOs are taxed when you exercise them. The difference between the exercise price and the market value at the time becomes ordinary income, appearing on your W-2 form. If you hold the shares post-exercise, any further gains are taxed as capital. Restricted stock units, RSUs. RSUs are another common form of equity compensation. Taxes on RSUs kick in when they vest. At vesting, the full market value of the shares counts as ordinary income and is subject to withholding tax. Subsequent gains after you've received the shares and paid taxes are subject to capital gains tax, depending on how long you hold the shares after vesting. Thus, RSUs are straightforward but require planning to manage tax responsibilities effectively. Performance shares. Performance shares are awarded based on meeting certain company metrics. Upon meeting these performance conditions, and should the shares be granted, taxes work similarly to RSUs. The market value at the time the shares vest is considered ordinary income. It's essential to monitor vesting conditions closely to anticipate when the tax event occurs. Tax strategies. Equity compensation can be financially rewarding, but without a tax strategy, it might turn into a costly affair. Here are some strategies. Number one, plan and budget for tax. Understanding when the tax will hit helps you plan adequately. Consider working with a tax professional to forecast tax liabilities. Number two, consider charitable giving. Donating appreciated stock can help offset tax liabilities and benefit a good cause. Number three, manage your alternative minimum tax exposure. Particularly relevant for ISOs, staying vigilant about how much stock you exercise in a given year can help manage the AMT risks. Number four, diversify your portfolio. Post-tax stock diversification helps mitigate risk linked to over-reliance on your company's stock. Understanding how equity compensation is taxed is crucial in harnessing its potential benefits. While ISOs, NSOs, RSUs, and performance shares each have their unique tax implications, careful planning can help optimize their benefit. Always focus on aligning your financial goals with strategic tax planning, and remember to consult with a financial advisor if you brace any complexity. With due diligence, equity compensation can be an instrumental tool in wealth building. Make informed decisions and let your equity compensation work for you.